Hello everyone, welcome back to the channel. I hope you're doing well. CryptoArk here, and this is the second video of Trading 101. Today, we're gonna talk about fees and different types of contract. I know this is a boring, very boring topic, but I hope I can cover everything very quickly and you guys can clearly understand. This subject has to be crystal clear because it's so confusing, right? This is the same account that I showed to you guys. I just took a small trades while doing the other videos. So I was explaining, just went up $11, but anyways, let's start with the different types of margins, right? You can have two types of margin. Any exchange, you're gonna see USD and coin margin, right? Why is that? One, you're gonna use stable coins. So in Binance, you can use BUSD or you can use USDT. This is Binance, right? In Bybit, Femex, you're gonna use different types of margin. Let's have a look at Bybit, for example. When you go to derivatives, which is what we are looking for here, right? You can trade on Bybit, and again, you're gonna see the same terminology. Like you have USDT, Perpetual, and you have the inverse Perpetual is basically using the coin itself. Some people will call inverse because you're using the coin to trade the coin. Is that confusing? No, it's not. It's you're using BTC to trade BTC. So you're using your own asset to bet on your asset. Okay, you can long or short BTC using BTC. So that's what inverse means. In Binance, they try to avoid that. So instead they call coin margin, which in my opinion makes much more sense, right? It's just the ability for you to use the coin itself to trade the coin. So you can trade BTC using BTC, right? My account here has no coin M yet. So in this account, I'm not playing yet with coin M, just USDT for the sake of the video. So that's it, right? Some people will call it inverse. And now let's talk about the future, right? Some people will call it future, and you can see those numbers. Binance will call it delivery, and you're gonna see the same numbers. And there is a thing called quarterly, right? When you go here, you're gonna see in some exchange the same terminology, but what is this? What is this future contract? Those numbers are basically dates. So 12/31 is December 31. 03/25 is March 25. Those numbers are fixed by the market. You're gonna see exactly the same numbers. They are the dates that we deliver a future contract. So that date is very important for the crypto in general, and you see a lot of volatility in that week, right? Because there are people trying to get out of their contracts. How that works, as you see here at the top upper right corner, instead of funding fees, you have funding fees when you trade Perpetual. You see here funding fees, yeah, see funding countdown. Now when you trade delivery, you have delivery date, right? Time to deliver, 132 days, 132 days. When you trade this guy, you're gonna have 48 days. It's gonna be the same thing everywhere, right? This is 132 days until delivery, and this one will be 48 days, okay? KuCoin, any exchange, you can always do that. You can always go for futures, right? And you have USDTM, CoinM. Yeah, they don't have that distinction here, but you can see quarterly 12/31, right? Same thing, okay? I don't think they have quarterly. Oh no, they do. They do have quarterly for BTC. Only USD. Okay, interesting. So it's inverse. Anyways, any exchange that you go, right? You're gonna find the same type of things. So quarterly is basically the ability for you to open a trade and don't pay fees per day, but you actually agree on a contract, agree on a date. So you have to close the trade before that date. If you don't, the exchange will close it for you with the current price at that time, at the time of the end of the contract, right? There are some specific rules like which hour, how many hours before you can open a trade or close a trade, but I'm not going to talk about that. It's too much technical details. Anyways, the important thing to understand here is there are two different prices, right? If we type here XRP, you're gonna see the XRP on Perpetual, which is the current price now, is just like spot, is 1.18. But on quarterly 1231 is 120. And 0305, which is next year, March next year, the price is 1.23. Why is that? Because the quarterly, the future contract, right? It's always calculated in the future. So the exchange has to make a calculation based on the previous history or the recent history. Based on the recent history, the price is going up. So that makes sense that the price on the quarterly will be higher as well. It's not always that. Even in bull markets, you can see ADA. Sometimes the price on the quarterly can be even lower, right? Because ADA is one coin that we call it stable for a reason, right? Sometimes it doesn't move much. Without moving much, you don't move the moving average that much. The quarterly calculation, there is an algorithm, mathematical equation to calculate the price in the future that will be affected by the movement of ADA, for example. So, and of course, in bear markets, you're going to see the quarterly always lower than the perpetual, right? That happens as well. Not right now. Anyways, but you should not worry, right? That doesn't mean, oh, the price has to be that by the end of the time. No, probably if the price is 1.21 at that date, the quarterly price will be actually higher, right? And because there is a time involved, right? There is a time to deliver it. This price calculation diminishes over time. So it's a calculation between the remaining time and the previous history, right? Usually the beginning of the contract, when it first opened. The contracts are always 6 months. So this contract here in 1231, it exists in Binance since June. Meaning in June, the price that you would see here would be accounting the number of time or the time to delivery, right? As 132, which means the calculation is different. Anyways, I'm going too deep into that explanation. The point here is Perpetual is the one that you're going to pay fees, funding fees, right? So every 8 hours, no matter which exchange you go, you're going to find the same thing. You're going to find that you have a funding fee. And that funding fee has a countdown. Again, the countdown is going to be exactly the same, 4 hours, 28 minutes on every single exchange. Why? Because it's a market agreement, right? A market agreement on how we want to use the funding fees and the contract delivery dates. And there is, of course, some sort of unify behind it. Anyways, what is important about funding fees? You pay that every 8 hours. You pay that 4 times per day. What is this? 0.01% is over the amount of the trade. So let's start doing some examples here. I'm going to open this, not the bake, definitely not the bake. Go back here. I'm going to open this Bitcoin position, right? Just one, so we can have a discussion over it. As you can see, my liquidation price, of course, doesn't exist because of the strategy that I explained in the first video. This guy right here, my risk in this trade is absolutely zero. That's insane. Anyways, when I do that, you can see here in the history, you saw the button, this button right here. Yeah, that's the history. You go to trade history and you're going to see what happens there, right? I opened this trade using the market price, meaning I'm going to pay 0.25 cents as fee. okay? If I now close the trade, I'm gonna pay exactly the same, right? I can close the trade using this button, or I can close the trade doing a sell action, okay? With the, of course, the same amount. So if I do sell here, or if I close here, is the same thing, okay? When I go there, back again, this guy now had me a P&L of 0.1, but my funding fees again was 0.25, exactly the same as the open. So if you combine both, you have now 0.05 as fee combined, right? So I lost money just in this trade, okay? By using the market. If I want to save a little bit of money, I should use limit orders, right? Because limit orders, they take time to be filled. So you see here, this yellow triangle, that's me. If this order got filled, I will explain to you what happens. But basically, the limit order has much lower fees because that makes sense. You're giving to the exchange order book liquidity, right? And when you do liquidity, you get reward. So this trade got filled, yeah, the order got filled, right? So when the order got filled, as you can see here, is the same size. So the fees are based on the size. So 001 got filled, and here 001 got filled, 001 got filled, right? When you do limit orders, the fees that you pay to open and close the trade, they are much smaller. In this case of BTC, they're half right now. Of course, that changes a little bit if you have, some in Binance. There is a discount of 10% in fees if you use BNB, right? So if I keep BNB here, I take 10% off. Sometimes in the market that is good, right? I don't do that very often because I lose more money with BNB going down that actually I save 10% on my fees. Anyways, I'm gonna close this trade again. If I close, when you close here is market order, right? When you do stop loss or profit using this tab right here, right? This is market or limit order, so you can always do one of those. And if you do market, of course, you're gonna lose or pay more fees, right? Market always pays more fees because it's what we call the takers, right? It's not the makers. Who are the makers? The limit orders. Why they are makers? Again, because if I do a limit order, let's say at BTC at 60K, right? If I do that, what means right now, it's my money, it's locked, right? I cannot remove this money from here because it's locked. If you look at the assets, you're gonna see that my available for withdrawal, you see here on the lower right, is much lower than my margin balance or my wallet balance. Why is that? Because I have an order, right? If I close this order, you're gonna see now that it goes up, right? So why that happens? Because when you do limit, right, you're basically what we called a maker. So you're making the market, you're making liquidity in the order book, right? When you give exchange liquidity in the order book, that's the most important thing. They will give you, in return, lower fees, okay? That's how it works. I mentioned on another video, maybe I will explain again, on Forex word, we understand all of that. Why liquidity is so important, right? Because Forex is not a player, it's not a game for small players, not a game for retail traders. It was first invented as a game for big banks. If Citibank wants to trade $100 million with Bank of America, and they want to trade euros for US dollars, right? The price fluctuate, of course. The economies in the world fluctuate, right? So if they make a trade today and tomorrow the price goes down or up, they're basically screwed, right? They lost a lot of money if they made the trade and the price moves. Well, That's why they have liquidity. They don't bankrupt, they don't get broken just because they lose a trade. So that's the concept of, one of the origins of risk management. But anyways, I'm deviating. Back to the trade here. Never use the button close all, please. I'm gonna use it here, but basically when you do that, in Binance and most of the apps as well, like in Bybit, when you do close all, they actually close both open positions and orders. I would love to see Binance improving this, having an option here to say only open trades, don't close my limit orders because I don't want to lose or remake all of that again. Anyways, when you do close all, you basically close both, okay? So back here, trading, fees, that's what I have paid. In this trade, I made a little bit more, but just the fee, if I combine the fee to open the trade and close the trade, you see here buy and sell, I actually lost money again, okay? One important thing to understand on those strategies is when they offer you different positions, that means they offer you more tools for trading, right? Meaning on BTC, you can have 3 positions on coin plus 3 positions on USD as well. So you can have perpetual on BUSD or perpetual in USDT or even quarterly, right? You can have 6 different positions open on Bitcoin, on Binance, right? We're going to talk in the future strategies for losing trades, but definitely that's one of the strategies, right? If you have a losing trade on USDT, that is bleeding, a trade is bleeding, what do? You close the trade and take the loss? No, you just leave it there because you just risk 1% and you don't have to worry about liquidation. Now you're gonna play your game again on a different contract, okay? With this contract, you can take the profits here and start slowly, one by one, closing here. So you save your loss. You end up losing nothing, okay? No liquidation, and you also don't lose money. I love so much trading. This strategy is so good. Anyways, I hope you guys understand now what are the difference between different contracts, right? Perpetual and delivery, and why some exchanges offer it, right? And all of that makes sense. As Binance is the biggest one, they have more liquidity. They have this crypto liquidity, right? So they can definitely handle things. If everyone, is trading on coin and they actually win everything, who is going to pay? We are playing against the exchange itself, meaning they have to pay. Binance have to pay. So they only offer this kind of service to a small number of coins, which makes sense because those are the coins they have most, okay? When they charge fees in this contract, this kind of also called inverse contracts, right? Also called inverse contracts somewhere. The fees are paid in the coin itself. So that's how they also get more liquidity, right? Everyone trading BTC on Bybit, for example, pays in BTC, Ethereum, EOS, XRP, DOT, and so on. Those are the 2 contracts. That's how we use perpetual and quarterly. Those are the different kinds of fees we have. Those are the funding fees, how the funding fees work. Why do exchanges use the funding fees? To stimulate people to trade. When they lower the fees, when they raise the fees, they lower the risk. It's all a very, very complicated, not complicated, but very sophisticated equation, right? Leave your comment down below. Let me know if I can help to explain anything else. If you have any questions, doubts. I know it's a boring video, but trust me, this one has to be spoken before we move to the next topics, right? You have to understand the difference between the different contracts, the different positions, and how many positions you can open in order to make your trading strategy, okay? That's it for today's, guys. I hope you enjoy. Smash the like button. See you on the next one. Bye.